Welcome to the Rick Helps Real Estate Show. I thought I'd mix it up a little bit today, a little green screen action here. Pat is not with me where he usually is on Fridays at 3 o'clock, but he is on a cruise in the Caribbean. Sent me a couple photos yesterday. Looks like he's having a good time. So I think he's probably going to bring me some rum. I don't know. So I'm just putting that out there. Anyway, things are getting interesting. The markets were closed today. Happy Veterans Day to you veterans out there, and thank you. Markets were closed. Little bit of movement on the mortgage rates and the overnights. We went up to five. Yeah, you don't know what you're talking about, Rick. We went up to 7.5, I believe it was 7.56 from 7.4 the day before. So nothing major, but still a move upward. And it's just kind of staying there. There's a lot of activity and a lot of anticipation because of the bond market, the bonds that have to be sold. The Treasury's selling so they can raise money because of the debt. I'll touch on that in a little bit. But let's take a look at what's going on in our market today as we approach the fall market. This is Q4. Things really slow down in Q4. It's historically not a bad time for buyers because inventory tends to grow in November and then it shrinks after that. But there's very few buyers out there. And sellers, I don't think it's time to run for the hills the closer you get to Christmas because the buyers that are out there are serious. But on top of that, the builders, they do like closeout sales, just like the car dealers. So they'll throw everything at you but the kitchen sink in the next couple of months. So if you are looking at new builds, pay close attention to what they're offering you from the design center and for rate buy down. So here is where we're at today with the Cromford Market Index. Now, when it says it's down 17% here, Chandler, that does not mean we're down 17% in pricing. Hello, Danella. And that just means the index is down 17%. Last month, it was 195.6. Today, it's 163.3. And you can see the cities here that are still in what's technically called a seller's market. And then the commentary down here goes on to say the market is still weakening at a fast rate with the average decline of 16.3 in the Cromford Market Index for the 17 cities above. It ends and says, despite the above, we are starting to see a slight tick up in some of the listings under contract numbers as the market reacts to the very recent decline in mortgage rates since the start of November. Now, that's curious to me because the market did react. Mortgage applications went up. We started seeing more contracts, and the rates only moved about a quarter of a point, maybe a half a point, but they were still above 7. Yet the activity picked up. So it's like, are people saying, well, probably going to be in the high 7s for a while. Now it's in the low 7s. Let's see what we can do. But there is a lot of buy downs going on out there, and I'm going to show you that as well. Here's what our inventory is today. 14,162. This is according to the Cromford market data as of Monday, the beginning of the week. They change it every Monday. So it continues to grow about 300 to 400 a week. I expect this, as it always does, to kind of start going down closer we get to Christmas. People just don't like the list over the holidays. Now, what I'm seeing in my 7-day moving average, though, is interesting. New listings started to go up, and then, boom, they're headed back down, while sales continue to stay right at that 2,200 level. We went from a gap of 62% up to 67%. Pretty healthy. If we go back here and look, this one is curious as well. Look at the drop in canceled listings. Closer we get to the holidays, I thought we'd start seeing that go up. And we may yet, because you can see in 2022, the canceled listings went way up. Closer we got to the holidays. They did here in 2021. They did slightly in 2020. So I think people will be saying, let's just take it off the market. Don't want anybody coming through my house during the holiday season. The other number that I'm looking at that I track all the time is number of price changes per week. We did have a total of $38 million worth of price changes, which is a big number, price reductions. But when you look at it historically, it really wasn't that out of whack. It just goes to show you that people are always still trying to start here, and then they have to come down. And now we're looking at 2,110 price cuts, 2,040 price cuts versus 2,110 last week. And the median price amount that they go down, this number never seems to change too much, but we're at, that's not the one. This is the one I want here, median price amount. Isn't that curious? It's just 10,000 constantly, 10,000. Price, total amount of price changes. Here we go. We were 42.1 million last week, October 29th, 38.6 million. When the rates shot up from 3 to 7, you can see that people put their house on the market, and then by the time they got to November, they were cutting prices like crazy. And remember, a lot of that was driven by the iBuyers. They started cutting prices. They were trying to get rid of their inventory, and they were worried that they weren't going to be able to move anything. And lo and behold, they did. You remember when Open Door had like 1,800 listings on the market? I believe now it's somewhere around 60. And they don't seem to be much of a player out there in purchasing either. So I don't know if and when that's going to ramp up. They were 6% of our market at one time. Now you barely hear about them. So their stock seems to be doing okay. Even Carvana, that looked like they were on the edge of bankruptcy, seems to be doing okay. They got some cash and some funding. So interesting watching this stuff. Now this one here, this is the Cromford supply demand index and supply, and you can see here that they're still apart, but they are moving closer. If and when they meet like they did back here in 2022, then you can expect more price reductions. And what you'll expect then, if that happens, is you'll see that the average sales price will have come down. Now, if you look at the Cromford index, it's indicating a softening, which looks like January is probably, I don't think we're going to see any upward pricing pressure in January. Now, people say, Rick, you've really changed your tune. I'm just telling you what's going on today, folks. I've never been a crasher. I've never been buy. I'm just like, here's what's going on today. If we see these numbers continue like they're going now, January is going to be soft for sellers. Will it be a huge opportunity for buyers? Probably not, but it depends. If we have a whole bunch of people that are sitting back and waiting to list their house in January, which a lot of people do, and all of a sudden they do, and we go from 14,000 to 19,000 homes, then yeah, buyers will be in the driver's seat at that point. And the Cromford index here is showing that we're approaching overall this balance line right here. See that? So balance is 100. So you can see we dipped way below it back when we had the crash, and then up in the stratosphere is during what I call the silly season. So we're approaching that. Didn't come up a little bit today. It's kind of staying put, but the market is definitely soft, but prices are holding on. Now, I had a video come out a few days ago questioning and saying, what would the market look like if there weren't all these seller contributions, especially when it comes to new construction? What's the real price? Because when one of our subscribers actually raised that question the other day and said, I think prices are down further than it looks like because of how much seller contributions are going on out there. And let me look at this again. Seller paid closing costs. Some of the builders are offering $30,000 to $40,000 for you. Do whatever you want with it. Buy down the rate, get more fixtures, upgrades. They're throwing it at you. So think of it in terms of, okay, so you bought that with $30,000 worth of incentives. Let's say you wanted to sell that without $30,000 in incentives. What's it really worth? And that's the market that we're in. Now it's working because people are getting the payments that they like. So they're moving in, got the incentives, got the rate they wanted. They're planning on staying put. Probably going to be okay. If you look here, here's our seller concessions, seller paid closing costs, median concession 10,000. We're still at 40%. That was the week of November, first week of November. So we're still at 40%. They were as high as, it's still statistically saying 45%. So they went down a little bit, but resale people are contributing like crazy too. You have to if you're going to compete. I mean, and especially in towns like Maricopa, Buckeye, Tolleson, understand who your neighbors are. It's new construction. We're not seeing a lot of new permits coming on out there. So Building's going to start slowing down a little bit. That'll make this market look pretty different in about 2 or 3 years. Will we end up with another shortage again? Now, I touched on the subject of our debt, and I'll show you that busy clock here in a moment. And mortgage markets are being affected by how many treasuries have to be sold. In other words, to fill up the treasury bank account. That's how you get it. They borrow money. And what they did was they borrowed money when interest rates were really low at a really low rate, but a very short term, 2 and 3 year terms. And then they reset, and our interest payments on our debt went nuts. So the country is kind of like created their own adjustable rate mortgage problem. Borrowed all this money at a low rate, and then it reset. How bad is it? Well, I'll show you here, and it's a busy chart, but I'll circle it for you. Right now, our tax revenue is 4.4 trillion, and we're spending 6.2 trillion. So we have a deficit. What we're looking at is the interest on the debt now, right here, 679 billion, is almost as high as national defense. Now, why do I bring that up? Well, that's the direct result of interest rates going up. So now you have to ask yourself, and if you're an economist out there, maybe you can let me know, but you're looking at the central banks here saying, well, we might come out. He dropped the bomb today and said, we're not ruling out having to hike interest rates down the road. All depends on the data and what we see. Seems fair. It's interesting that the higher you get towards 8, the more people talk how our mortgage rates are going to be 9. You go down a half a tick, and all of a sudden, realtors like, we're going to be in the 6s in January. Well, probably not. And I've seen memes out there of all these buyers going out getting like crazy. Slow down. We only went down about 1/4 point. But what's going to be the biggest concern to the central bank? The interest on the debt getting out of control, or housing? Will they just say, inflation be damned, we've got to do something about this interest on the debt, get rates down to where the government can actually refinance again and get lower rates, only this time do it long term instead of short term? I remember when Janet Yellen was telling the administration, borrow as much as you can, get these infrastructures done because the money's free, borrow. And they did. And well, here we are. She had them borrow at short-term interest rates. And so, again, I equate it to your own country having an adjustable rate mortgage. You went from a 3% teaser rate to 7.5% now, and you're getting hammered. So if you're in the finance world out there, let me know how wet I am on that theory. I just think something's going to break. And if people are holding out for lower interest rates, something's going to have to break for that to happen. And it's either the economy starts falling apart, the interest on the debt is just out of control, and they got to roll it back quickly. So there's a lot of worry that they're maybe clamping down too hard. So nobody knows, and certainly I don't know, but those are the things that I'm looking at. And it could go the other way. It could go to where they make moves to handle the debt, and it could propel real estate to go crazy again. That's a very real possibility. So as you're sitting back and you're waiting for real estate prices to crash, keep that in the back of your mind. They may not. You may not be able to afford it for a long, long time, but it may not crash. So I'm looking at both sides of that. There's also plenty of opportunities out there that say that housing can be into trouble. So if we get up to 20,000 listings in January and February, and yet our sales don't climb above 2,200, prices are going to come down. And they'll probably come down at a double-digit clip by the time you get into the spring. But that depends on rates. We've already seen that when interest rates go down just a little bit, mortgage applications go up. It's a very hard market to track, and it's extremely hard because we don't have any interest to look back on. We don't have anything that says, well, the last time we tried rolling back this much of spending out there, here's what happened. We just have nothing to compare it to. That's the market that we are in today. So I hope everybody has a great Friday and a fantastic weekend, and I will see you later. Oh, I've got a video coming out before I go. I've been asked about what I think about this lawsuit. It's $1.8 billion against the NAR and Keller Williams. So got a video coming out telling you what I think about it. That and 10 cents will get you a cup of coffee, but it's coming out soon. Might come out over the weekend. Have a great weekend. Talk to you soon.